Hey everyone, and welcome to another deep dive. Ever wonder how currency traders make those lightning fast decisions, with millions of dollars on the line?
It's a skill, for sure.
Well, get ready to go behind the scenes because today we're going to break down the strategies and the psychology of a real-life trader, Samuel J. Ray.
Yeah. And we're not just talking theory here.
Right.
We're diving into Ray's Diary of a Currency Trader, where he actually chronicles 3 months of his actual trades. Wins, losses, you name it. It's all there.
Wow, so it's like we're getting a front row seat to his trading desk.
Exactly. You're looking right over his shoulder as he makes these trades.
So, okay, paint the picture for us. The currency market's just a whirlwind of numbers, charts, flashing lights. Most traders are like glued to their screens to the news, right? They're trying to absorb every economic report, every tweet that might move the market.
Yeah, they're trying to get any edge they can.
But not Ray, right?
Not Ray. He actually tunes it all out. He's different.
Really, he just tunes it all out.
He does. Ray believes that by the time news hits the news wires or whatever, it's already priced into the price, basically. He calls this information arbitrage, which is a fascinating concept.
So he's saying that by the time it hits the news, it's old news, basically.
It's old news, and the market has already reacted. So
Wow.
think about it. In today's world, everybody's so interconnected. Everybody's trying to get that information and capitalize on it as quickly as they can.
Right, yeah, everyone's trying to be the first one to the punch.
So by the time you see it, chances are it's already been priced in.
Interesting. So if he's not glued to CNBC or Bloomberg or whatever, what is Ray looking at? What's his secret?
He is laser focused on what he calls price action. Now, this is just the raw movement of currency prices.
Right.
He believes that those seemingly, like random ups and downs.
Which is what everyone else is probably freaking out over.
Right. He thinks those actually tell a story. They reveal the balance between buyers and sellers, the fear and the greed that's driving the market.
It's like reading the market's mind.
It is. It's like deciphering a secret language that, 99% of people just miss entirely.
That most people don't even know exists.
Exactly. And he doesn't need these super complicated algorithms or trading software to do it.
Really?
Ray's toolkit is actually surprisingly simple.
What?
He relies on daily charts, something called candlestick patterns, and historic price levels.
Okay, so let's break those down a little bit because I'm sure some of our listeners are familiar, but let's make sure we're all on the same page. So, daily charts first. What does that mean?
So instead of getting lost in the minute-by-minute noise, he's really taking a step back,
Okay.
looking at the bigger picture, the longer-term trends and patterns.
So looking for the forest, not the trees.
Precisely. He wants to see the forest through the trees. And he prefers daily charts because that helps him to identify those longer-term trends.
Okay. So we've got our daily charts. What about those candlestick patterns you were talking about? Those sound kind of intimidating.
They sound intimidating, but they're really not once you get the hang of them.
Okay, what are they?
So picture this. You've got a candlestick, right? It's got a body that represents the opening and closing price for the day. And then you've got these lines sticking out called wicks, which show the high and low that the price hit throughout that day.
So it's not just where the price starts and ends, but it's like the journey that it takes throughout the day, kind of, yeah.
A journey, you got it. And these candlesticks form different patterns. Each of these patterns has a story. And some suggest that the buyers are in control, and some suggest that the sellers are dominating. And he uses these to kind of see what's going to happen next, anticipate, are we going to see a reversal? Are we going to see a continuation?
So it's like he's looking for clues
Right.
in the way the price is moving, like those little hints, those little tells.
Exactly. Exactly. He's looking for those little hints.
And then the last one on the list you said was historical price levels.
Right. So he also believes that history tends to repeat itself in the markets, which, a lot of people believe.
Yeah, makes sense.
So he identifies these key support and resistance levels from the past. Basically, points where the price had trouble breaking through before.
So if a currency, say, struggled to, I don't know, break above, whatever price point in the past, Ray would see that as like a possible resistance level going forward.
Right, like it's this invisible barrier. And on the flip side, if it bounced back up from a certain level before, then that could be a support level. So he uses these markers, these historical markers, to see, okay, is it going to reverse? Is it going to bounce back?
So he's got his daily charts, he's got those candlestick patterns, he's marking up those historical support and resistance levels. It's like he's putting a puzzle together.
That's a great way to put it. He's putting a puzzle together and looking for those moments where everything just clicks.
And he's like, uh-huh.
Yeah, exactly. And what's fascinating is he combines these seemingly simple tools with this really deep understanding of trading psychology, which is
Okay, so we've got a good picture of like Ray's, his toolkit, those daily charts, candlestick patterns, the historical support and resistance levels.
right, the basics.
Now, let's dive a little deeper into those patterns. Are there specific candlestick formations that he really likes?
Yeah, absolutely. While he's got his eye out for a few different formations, there are three that really stand out.
Okay.
The pin bar, the inside bar, and then the inside day turnaround.
Okay, those are some pretty descriptive names.
Yeah.
So let's try to picture these, right?
Sure.
What do these candlesticks actually look like?
So imagine a price is trying to surge upwards, but then bam, it gets slammed back down, right? And it leaves this long tail above the candlestick's body. That is a bearish pin bar,
Okay, so it's like the market's trying to make a move,
trying to break out.
break out, but the sellers are like, nope, not today.
Not today. And that long tail, or the wick is what it's technically called, that's a sign of rejection.
Okay, got it.
Now flip that picture. So now a price is plunging down, but buyers swoop in, push it back up, and this leaves a long tail below the candle body.
Okay.
That is a bullish pin bar. So that's indicating the potential for an upward move.
So Ray's looking for those pin bars, especially at those key support and resistance levels that we talked about?
Yeah, he's looking for those converging signals. So, picture this. A bullish pin bar forming right at a support level. That to him is like a double whammy of bullishness. Like it's really a strong signal.
Yeah, 2 thumbs up.
Exactly, exactly.
Yeah.
It's telling him buyers are stepping in and the price is probably going to bounce back up.
Got it, okay. What about the inside bar? That's a funny name.
Yeah, so for the inside bar, imagine two candlesticks, right?
Okay.
And the second candle, it lives entirely within the high and low range of the first candlestick.
So it's like the market's taking a nap or something.
Yeah, it's like taking a breather. It's unsure which way it wants to go.
Like a pause. Okay.
Yeah, exactly. But Ray sees this as a coiled spring, right?
Okay.
He's waiting for that moment, that breakout moment.
Yeah.
When the price finally breaks out of that inside bar's range, then you know something's going to happen.
It's like it's not the inside bar itself, but
Yeah.
what comes after that, he's watching.
Exactly.
Okay.
Now, the inside day turnaround, this one's a little more complex.
Okay.
But bear with me. This is a favorite of his.
Okay.
So imagine the market, it's been trending down all day, right?
Okay. Yeah.
Inside bar forms. So hinting at a potential shift, maybe, maybe not, and then suddenly the price breaks out above the high of that inside bar.
Bullish.
Bullish, right. But, and here's the kicker, for it to be a true inside day turnaround, the price has to retrace and close back within the range of that initial inside bar.
Whoa. So it's like dipping its toe in the water. It's like, is it safe? Okay, I'm going back in. No, I'm good.
That is a great way to put it. He sees this pattern and he's like, okay, the downward trend might be losing steam.
Okay. So these candlestick patterns, the pin bars, inside day turnaround, that's like his bread and butter.
Right, butter, especially when it lines up with the historical.
It all comes
It
together.
all comes together.
But I have a feeling there's got to be more to it than this,
Sure.
than just spotting the patterns, right?
Yeah.
What about risk? What about when he loses? Because he has to lose sometimes.
Right, that is the question, right?
Yeah.
Recognizing these patterns is just one part of it. Knowing how much to risk on each trade, how to protect yourself when things go south, that's what separates the.
The rookies from the veterans.
Exactly. And Ray is a stickler for risk management. He lives by 3 golden rules.
Okay, let's hear them.
Okay, so golden rule number 1, it's deceptively simple, but a lot of people, they trip up on this one.
Okay.
Never risk more than you can afford to lose.
Yeah.
Like he really emphasizes, trading with money, you need to pay rent or to buy groceries. That's a recipe for disaster.
Yeah, they'll make you pull your hair out. You'll just be a nervous wreck the whole time.
Exactly.
You can't be making rational decisions that way.
And he actually talks about a time early in his career when he broke this rule, poured a bunch of his savings into a trade, and it just totally blew up in his face.
Oh.
Tough lesson, but
Yeah, you don't want to learn that one the hard way.
you really don't.
Okay, so golden rule number 1, protect your assets.
Protect your capital.
What's rule number 2?
Rule number 2, never risk more than a fixed percentage of your account on any single trade, and this is no matter how tempting it looks.
Okay.
Ray, he sticks to a strict to 2.5% risk limit.
So even if he's like, this is it, this is the one,
Yeah.
he's still only putting in 2%.
That's it, because he compares it to a marathon, not a sprint. He's playing for the long game.
Mm.
And by only risking a small percentage on each trade, you ride out those inevitable losing streaks. You're going to have them, but you ride them out and your account survives.
Exactly, yeah.
Yeah.
Live to trade another day.
Exactly. You live to trade another day.
Okay, so don't trade with money you need, and only a tiny bit of what you do have set aside to trade. What's the last one?
This is key. Aim for at least a 1.2 risk-reward ratio.
Okay, so for every trade he's making, he's potentially looking at making twice as much as he's putting in.
At least twice as much.
Why is that so important?
Because, get this, even if Ray's only right half the time, 50% of the time, that ratio means he can still be profitable. He actually points out, even with a win rate below 50%, if you manage your risk correctly, you can still be profitable.
Wow. See, that's something you wouldn't necessarily think of, right? It's not just about being right. It's about...
It's not about being right all the time. It's about making sure your winners are bigger than your losers.
That makes sense. That's really interesting.
It's huge. But of course, it takes discipline, especially when you're staring at a losing trade and you're like, oh no, what did I do?
Absolutely. Yeah, you've got to trust the process.
You got to have faith.
Yeah.
And that kind of leads into his next point, which is control. You got to be able to detach yourself emotionally from each trade. He actually admits he used to get caught up in this euphoria of winning.
Nice.
But then, of course, the lows at the losses,
Yeah.
it really messed with his head.
Who starts second-guessing everything.
Exactly.
Yeah.
And it made him doubt his strategy, and he realized, okay, I got to cut this out. So emotional control is crucial for consistent trading. Trade the plan, not your gut.
Don't get greedy.
And that brings us to, his final psychological pillar, which is patience.
Which is, I'm sure, the hardest one.
Oh, the hardest. He talks about how dangerous impatience is when you're forcing trades, chasing the market.
Right, like you're trying to catch a wave that's already crested and crashed.
It's like a great analogy, yeah. Like you've already
Yeah.
missed it and you're just like left with the foam.
Exactly.
So it's about being disciplined enough to wait for the right opportunities, the setups that fit your plan.
So you're not just like throwing darts at a dartboard hoping something sticks.
Exactly. And when you find those setups, let those winners run.
Don't like cut your profit short because you're afraid.
You have to have the conviction to ride it out. Even when every bone in your body is telling you to cash out, let it ride.
So we've got his toolkit, the risk management rules, the psychology. But how does this all actually play out? Can you walk us through a trade that we might see in his book, in his diary?
Yeah, let's rewind to February. Ray had been watching the British pound kind of weaken against the US dollar.
Okay.
That's the GBP USD pair, if you follow along. He spots a bearish pin bar forming on the daily chart right at that key resistance level.
Oh, so a bearish signal at a place where it's already been hard to break through. So classic Ray.
Classic Ray. So he decides, okay, I'm going to sell this pair. Places a stop loss just above that pin bar's tail, right? So he's minimizing his risk just in case things go the other way. He sets his profit target at a previous support level, giving him that juicy risk-reward ratio that we talked about.
So he's in it to win it.
Well, not so fast. Initially, the trade doesn't go his way.
Oh.
The price actually moves up a bit, testing his patience, and actually, it even triggers a few more of his sell orders that he had kind of pre-programmed in. This is where the rubber meets the road with the risk management and the emotional control.
Right, because now it's like, did I make the right choice?
Totally. And he could easily get shaken out, but he trusts his analysis, keeps his cool, and guess what?
What happened?
The tide turns, the pound starts to weaken just like he thought. Trade moves into profits, and over the next few days, the price just keeps dropping, hits that first profit target, boom, locks in some profit, moves his stop loss to break even on that remaining position, so now even if it reverses, he's not losing anything.
He's playing it smart now.
Playing it smart.
That's great.
And run it did. The price just kept plummeting. It hit his final profit target.
Wow.
Textbook Ray. Patience, discipline, and that deep understanding of the price action.
It's really amazing to see it all come together.
Yeah.
And, it's clear that these principles that Ray's laying out, these aren't just for these like high finance currency traders, right?
Yeah, not at all.
It can apply to so many things.
This is relevant to anyone who wants to make smarter decisions. I mean, whether you're in the market or just in life.
Absolutely. His emphasis on risk management, emotional control, and patience, I mean, those are valuable everywhere.
Couldn't agree more.
Well, this has been fascinating. Really appreciate you breaking it all down for us. If there's one key takeaway from Samuel J. Ray and his Diary of a Currency Trader, it's that a simple, rules-based approach combined with the right mindset, you can do some pretty remarkable things. Thanks for joining us on the Deep Dive.